When I started investing, I was looking to make some quick money. So I tried a few things like penny stocks, swing trading, and even cryptocurrency, all with varying success. But one day, I had this bazinga moment where I was like, I think I know how to make money 100% of the time. And I thought I was a genius. So the first thing I did was I went online and looked at all the different dividend stocks that were going to be paying the dividend in the next week. And I filtered them out for the highest yielding dividend stock. And then after that, I went into my account and proceeded to sell all my stocks. But then a little voice in my head said, "No, don't sell that stock. Search Google first." Turns out, I was wrong. Someone else thought about this before. And of course, if I thought about it, someone else must have done it because there's nothing new under the sun. If you guys have ever thought about this idea yourselves, smash that like button to let me know. The thing I learned from this whole thing is that there's no guaranteed way to make money 100% of the time in the stock market, because the stock market's not like a Pokemon game where everything is rigged in your favor. So today in this video, I'll be going over dividend stocks and how they work, as well as why you can't flip dividend stocks for a profit. So to start off, what are dividends? So in short, dividends are essentially profits from the company, which a company decides to distribute out to its shareholders, or owners. And these corporations are generally for-profit corporations, where they're not looking to do charity work, but they're looking to earn money and reward their owners with this money. So a corporation can do one of two things with its profits. So it can either take the profits and reinvest it back in the business or hold it in cash there, or it can take its profits and reward shareholders by paying them out to the shareholders. And these shareholders are people like you and I who are buying stocks on Wealthsimple Trade, TD Direct Investing, or any other sort of brokerage platform. And as a shareholder, you're essentially an owner of a business. You don't own the entire business, but just a piece of it. And as an owner of the business, you want to eventually make a profit from this business, either through capital appreciation, so basically the rising price of your stock, or through dividends, which are paid out in cash. And typically, if a company is paying out dividends, they pay their dividends out quarterly, monthly, or sometimes bi-yearly like Disney. And as the company becomes more and more profitable, likely these dividends will increase. So how do dividends work? So as an investor in dividend stocks, there are 4 different dates that you need to be aware of as a dividend investor, because this is essentially the 4 dates that are important in the dividend process. The first date is the declaration date. And the declaration date is typically done when a company reports their quarterly earnings. On the date of declaration, the company announces how much they're paying as a dividend, when the dividend will be paid, and the record date. The record date is the second important date that you need to know as a dividend investor. So on the record date, what happens is the company goes through their books and goes line by line to see who are the individual shareholders of the company. They record the name, the number of shares they have, as well as how much they're going to be paying out to this shareholder. And once they record this down, this is set in stone. If your name is written in the books, then you receive the dividend. But you don't receive the dividend on the record date. You'll receive it on one of the later dates called the payout date. But before we talk about the payout date, we need to talk about the ex-dividend date. So the ex-dividend date is actually not declared during the declaration. However, it can be known by investors based off of a stock exchange's rules. And the reason for this is because when you buy and sell shares on a stock exchange, there's always some sort of lag between the transaction. So when you sell a share, for example, you don't instantly get the proceeds. Well, technically you do because the bank just gives it into your account. But if you were to actually trace the money doesn't actually transact that instant when you sell those shares. There's actually a time lag in between. And this time lag is either 1 or 2 days. The reason why this ex-dividend date is important if you're a buyer of dividend stocks is because when you buy a dividend stock, that dividend stock doesn't actually get transferred into your name right away. There's always 1 or 2 days in between, and that's dependent on your stock exchange's rules. So the reason why the ex-dividend date is important for a dividend investor is because you want to buy your dividend stock before the ex-dividend date in order to be recorded by the company as a shareholder. If you buy on the ex-dividend date or after that date, you won't be recorded on the books by the company and you'll miss out on the dividend. So I want to repeat once again, if you're looking to buy a dividend stock and receive the dividend of the next payout date, make sure you purchase it before the ex-dividend date, not on or after it. Otherwise, you won't be eligible for that dividend. However, technically, it doesn't really matter, and we'll talk about this later on in the video. And the last date in the dividend process that you should be aware of is the payout date. And this is essentially where you and I as investors get paid. And this payout date is announced during the declaration. So if you want to know when the dividend is coming into your account, look for that payout date during the declaration. So now you understand the process of how dividends work. What kind of dividend companies should you be looking for? And here are a few things that you should look out for when you're looking to buy a dividend company. The first thing you should look out for is a payout ratio. And this essentially tells you how safe the dividend is. The ratio essentially tells you the earnings the company has per share versus the dividend that they're paying out per share. And if this ratio is higher than 1, then the company is essentially paying out more than they actually earned. And this is a red flag. And when you're looking at a company for their payout ratio, look for anything under 70%. If it's under 50%, it's even better, because basically the lower the ratio, the safer the dividend. The next couple things you should look at is the cash flow and the cash on hand. And again, this ties into the safety of the dividend. If a company has a lot of cash on hand and some sort of storm like the current pandemic hits, they're able to continue sustaining that dividend because they have cash to be able to pay out even if their profits drop down. And for the cash flow, basically you want to look at if a company has a positive cash flow. The cash flow is technically the net cash that the company is receiving or paying out each quarter. And why this cash flow is more important than earnings is because earnings doesn't actually translate to the actual cash going into the company's account. Things like depreciation, amortization, as well as investor money are not included in the earnings. However, they are included in the cash flow. So if a company has amazing earnings but their cash flow is somehow very negative, this can also be a red flag because essentially their cash balance is decreasing and they could be at risk of going bankrupt or needing to borrow more cash. The third thing that you should look at is the dividend yield. And this is essentially for every single dollar you put in, how much are you getting back? So if the dividend yield is 2%, for example, each dollar that you put in, you're going to get 2 cents back per year. So the higher the yield, the more cash back you'll get each year. However, if the yield is a little too high, there's likely something fishy going on with the company, and you should dig a bit deeper into the things like the payout ratio, the cash on hand, or even the cash flow. Investors might be selling off the stock because the dividend is at risk of being cut. So typically a dividend yield of above 8% or so, you should definitely do a little bit more research into that company and see if that 8% is sustainable. Lastly, what you should look into is the business growth. Is this business in an industry that is flourishing, or is the business in an industry that's dying? So for example, in oil and gas right now, my opinion is that this industry is going to be shrinking over time. So these dividend yields of maybe 5 to 7% in the oil and gas industry, they might be great right now. I don't know if they're going to be that sustainable like 10 years down the road. However, for an industry like renewable energies, if you look at the world and the social norms, everyone's talking about how great renewable energy is and how we all want to help out the planet. So for renewable energy companies, you can expect them to grow for the next 10 to 20 years, and likewise, their dividend will also grow. You can also take a look at the business's revenue growth and their earnings growth over the past 5 years to see if this business is growing or they're shrinking. And now to come back to the question of why can we not flip dividend stocks to earn a quick profit? This question is very common amongst beginner investors, and at first glance, this theory seems bulletproof. Because as a beginner investor, you could be thinking, at $3.59 the day before the ex-dividend date, I can throw my money into the stock, and then instantly at 9:31 when the market opens the next day, I can cash out. And by that point, I'll be on the record of the company and I'll get that dividend payout. And within 2 minutes, how much can the dividend stock really move? But because everyone and their dog has thought about this, the market will account for this. And what happens when the ex-dividend date occurs is the share price actually drops typically by the dividend amount. However, this doesn't always happen because there are other things that could also affect the stock price, such as big news about a new development in a company. So let's say this company all of a sudden released news saying that they got this huge patent for this new design that they have, and this design beats out their competitors by 30%. This will move the stock up the next day instantly instead of decline by the amount of the dividend. However, the price movement has already factored in the dividend as well. So essentially, if that company didn't pay out a dividend, the stock price would have rose up even higher by that dividend amount. So if you have any more questions about dividends and how they work, let me know in the comments down below. As well as click the subscribe and the notification bell. Keep up the grind and have a great day.